Hello and welcome back. So today what we will be doing is that we will be doing this particular question called Morada. Okay, so let's see the requirement first of all. So what do we need to discuss? In the first requirement, explain how business risks and financial risks are related. So that's one part, right? How there is a relation between them, and how risk mitigation and risk diversification can form a part of a company's risk management strategy. So there is three elements to it, right? Three things that we need to discuss. Business and financial risks are related, risk mitigation, risk diversification, right? And then in the second thing, what we need to do is we need to prepare a report for the BOD of Morada, right? And then estimates. So estimates are always for numerical stuff, right? Estimate Morada company's cost of equity and cost of capital. Okay, so KE and WACC based on market value of equity and debt. Okay, based on market value and debt, market value of equity and debt. So that's how we normally do it, isn't it? Right, normally. And then before any changes, and then after. Before and then after, right? So it's two scenarios. Based on that, within that, like before and after, we have to find cost of equity and cost of capital, right? Implementing the proposal put forward by the first and the second. So only the first and second, not the third one. Okay, so there could be fourth one also. I don't know. I've not seen it, but still, yeah. Let's see. 17 marks. So that's a huge chunk of it, right? Of course. So there will be a bit of a caveat around like how to calculate all this equity and capital. So it's not going to be easy. They are not going to give us a easy marks, that's for sure, right? So second part. So what do we have? So basically in the report we will have like cost of equity and its changes that we need to show in the report, right? And then estimate the impact of the first and second director's proposal on after tax earnings. Forecast after tax earnings. Okay, so that's first part, right? So that's basically what we need to do is basically we need to forecast the after tax earnings based on first directors and second directors. Okay, so there will be one heading and then another heading will be financial position, right? So forecasted financial position, and then that also within that there will be two subheading for first director and second director. Okay, I'll show it to you even though if you don't understand. Okay, that's 7 marks, right? And then discuss the impact on Morada company. Discusses the impact on Morada. Okay, third requirement is discuss. So we'll have discussion session over here. Sorry, discussion heading as well. Discussion heading, and then changes of the proposed by the first and second directors recommend. So there is recommendation as well, It's always good to identify the requirements of the question, just taking a bit of time rather than just reading the text. Whether or not either proposal should be accepted, so we need to make a recommendation, so we have to make a decision as well. Okay, so discussion should include an explanation of any assumptions. Okay, assumptions should be there, so we will have some assumptions as well, right? This could be within the discussion thing as well, basically. And then after that we can have the recommendation at the end, right? Otherwise it won't go basically in the same situation. So in B1 and B2, right? So assumptions as well. So 4 marks is there, so 9 marks is over here, right? Okay. So what about this C number? Discuss the possible reasons for the third director's proposal. Okay, so there is third director as well. Proposal that a risk management strategy should consider each risk before taking appropriate action. Okay, so this seems like We will need to understand the whole study and then only work on this one. This one is basically a bit independent question kind of thing, right? So what shall we do? Shall we do this thing first, or what is it? Explain how business risks and financial risks are related and how risk mitigation and risk diversification can form part of a company risk management strategy. We could talk about it from an independent perspective, but we will need to read the case study so that we can put some relevant parts from the question as well, right? So that's always a good way to answer it. As you can see, this is very long case study. Okay, what do we have here? So Morada is involved in offering bespoke. So bespoke is what? Customized travel services, right? Travel services and maintenance services. So basically this seems like a intro of the company or background. So in addition to owning a few hotels, it has strong relationships with companies in hospitality industry. So it's obviously working, operating in hospitality industry because it's providing travel services and maintenance services. I just don't know what the maintenance services is. It has a good reputation of offering unique high quality. It's unique and it's of high quality, right? High quality packages at a reasonable cost. Okay. The strong relationships have enabled them to offer repair and maintenance service to number of hotels. Okay, so they basically provide, and cruise ship companies, so they provide repair and maintenance to all this cruise and then all these hotel chains, right? That's whom they basically cater to under this maintenance service that they provide, right? Those are their target customer. Okay, so following a long discussion at a meeting of BOD about the future strategic decision, which Morada company should follow, three directors continue to discuss one particular issue over dinner. Okay, so one particular issue in the meeting, BOD had expressed concern that Morada was exposed to excessive risks. Right? Excessive risks, right? So it's taking a lot of risks. So it's being exposed to excessive risks. So therefore, its cost of capital was high because if the risks increases, when the risk increases, of course, all the investors demand that, right? WACC is high. So BOD feared that several good projects has been rejected over the previous 2 years because they did not meet Morada's high cost of capital threshold. Okay, why does this normally happen? Why do you think so? It normally happens. Why does a project basically is removed from it's not selected? Because you see, when you have a high cost of capital, what happens is basically the cash flow, you are basically dividing it by the discount factor, right? So if the denominator is 10, right, 1 by 10, so of course your NPV will be greater, right? It will be greater than if you're dividing it by, if your cost of capital is 1.15%, right? So of course this will be less than this figure, right? Rather than being 10%, it's 15%. So the cash flow will be discounted at a higher rate. So that means the NPV will be less. NPV will be impacted, and then what happens? Those projects get rejected, right? So the project that are being selected could be like risky projects that are being selected, right? So that's why, or that's what's been happening as well. Because you see, in order to increase this NPV, what happens is, if you have a, let's say, stable project, and then you've got a stable cash flow, but your cost of capital, it's not the project's fault, right? It's our fault that our cost of capital is high, right? So the project is there. So that could be a project with very minimal risks, or the cash flow is does not have any deviation, much of a standard deviation in it, right? So it's consistent, and then basically our cost of capital is high, and then we could not accept it, right? And then the project gets rejected, and the projects that are being accepted have a very high deviation, and then their NPV seems high, but it's very risky, so these kind of ventures the company could go into. So that's what they are basically trying to say as well. So each director put forward a proposal which they then discussed in turn. Okay, so they discussed in turn. Okay, each director. Okay, so we have three directors, isn't it? Three directors put forward a proposal which they then discussed in turn. At the conclusion of the dinner, the directors decided to ask for a written report on the proposal put forward by first director, second director, before taking all three proposals to the BOD for further discussion. Okay, so let's see what was the proposal, right? So this is the first director's proposal, right? So we have some second director's proposal, then we have third director's proposal. Let's read through this. So first director is of the opinion that Morada should reduce his debt. Okay, so they are basically paying off, I guess, in order to mitigate its risks and therefore reduce its cost of capital. He proposes that the company should sell its repair and maintenance business. Okay, so sell is talking about selling off, huh? So which business? Repair and maintenance business unit, and focus just on offering bespoke hotel or travel services and hotel accommodation, right? In the sale, the book value of the non-current assets will reduce by 30%. Okay, book value of non-current assets will reduce by 30%. So book value of non-current assets will reduce by 30%. Book value of the current liabilities will reduce by 10%. Okay, so 30% and then 10%, right? So, and then it is thought that the non-current assets can be sold for a after-tax profit of 15%. So, okay, interesting. Sold for a after-tax profit of 15%. So, book value of net current assets is something into 30% equals to book value of NCA, right? For this hotel business only. Total non-current assets times this, and then whatever the book value is, on top of that they have a markup of how much? 15%. 15% markup, or if you just say 15% profit, right? Profit, yeah. And then the first director suggests that the fund raising from sale of the repair and maintenance service business unit and cash resources should be used to pay off 80%. Okay, so the new debt they will be having is only 20% left, right? So pay off 80% of the debt, long-term debt. And it is estimated that as a result, the credit rating will improve from BAA to A2. Okay, so there is something about credit rating as well. What happens basically, our discounting rate will change, right? So our cost of debt will basically be less because our rating has improved, right? Rating has improved. So that's the first proposal of it, right? Second director, what does he has to say? Is of the opinion that risk diversification, not risk mitigation. What was this one? Mitigated risks, right? Reduction, this is about diversification, is the best way to reduce Morada's risks and therefore reduce its cost of capital. So how does that happen? Risk diversification, basically what happens is the variability in the profits will be less, right? So in that way what happens is basically the risks will be reduced, right? Because we have the consistent cash flow, right? So, or I mean, like if you have a negative correlation between your cash flow and then suppose you are in other business, and then if something goes down in like the travel services business, the repair business is flourishing, or like it could, I mean like they are related in travel industry, but yeah, basically like if you have something else, like that's not a good example. Let's just say you are in other business such as what do you say, let's say in real estate or something like that, right? So as I can see over here as well, new commercial properties, so then your cash flow will be basically uncorrelated, right? So you'll have a negative correlation. That means even though if one sector is doing bad, the other could be doing well, right? So yeah, that could happen. And then what does he propose? To reduce his risks, he's proposing risk diversification strategy, right? He proposes that the company raise additional fund using debt finance. Okay, additional funds. And then create a new strategic business unit. This business unit will focus on construction of new commercial companies. So that's how they are going to do risk diversification. Basically, is have a new business unit which is different from the existing one. That's how a risk diversification happens, right? Otherwise, if you are in same industry, the risks will be basically same for the same whole industry as well, right? I mean, the industry systematic risks will be basically same. Okay. The second directors suggests that 70 million should be borrowed. Okay, 70 million should be the borrowing. So that's the additional amount that we will be um borrowing. So used to invest in purchasing non-current assets of construction business unit. Okay, so purchasing non-current assets. So the non-current assets will increase. Will be issued in form of 4-year redeemable bonds, paying an annual coupon of 6.2. Okay. So it is estimated that if the amount of debt is credit rating will worsen from CA3 to CA3 from BAA2. Current liabilities are expected to increase to 28 million, right? So 4-year redeemable bond. Okay, we will deal with that as well. Third director proposal is of the opinion that does not need to undertake proposals suggested by the first directors, and the second directors just need to reduce the company's risk profile. She feels the above proposal require a fundamental change in corporate strategy. Yeah, that's a change in corporate strategy. This one, the second director's proposal, this one is also a bit about change in corporate strategy as well, because you're selling off, right? And then what kind of products that you sell is being reduced. So that's a strategic kind of decision, right? So, and should be considered in terms of more than just tools to manage risks. Feel that above proposal require a fundamental change and should consider in terms of more than just tools to manage. Instead, she proposes that a risk management system, okay, should be set up to appraise Morada's current risk profile, considering each type of business risks and financial risks within the company, and taking appropriate action to manage the risks where it is deemed necessary. Okay, so Morada existing forecast financial position for the coming year for the coming year forecasted is all this information are given, equity and all, and then non-current liabilities is there, right? This is what we need to reduce and all. Other financial information is also given. So forecast tax earnings for the coming year are expected to be this much. Okay, after tax, after tax, so it's already deducted for tax. Okay, so that means everything we will need to add or subtract to this figure, we will need to do it in after tax. Estimated that company will make a return 9% return after tax on any new investments in the non-current assets, and will suffer a 9% decrease in after tax in any reduction in investment in non-current assets. So the first directors will suffer. The first director's proposal will decrease this forecasted thing, right, after tax, and then the other directors will basically increase the second directors, right? And then Morada current share price is 2.88%, 2.88 per share. According to the company finance division, it is very difficult to predict how the share price will react to the proposal made by first director and second director. Therefore, it is assumed, let's just write that in assumptions as well, share price will not change. That does not happen, not realistic, right? So which in reality could be very different. So basically this is about share price, right? What about this one? Financial division has assumed that the proportion of the book value of the non-current assets invested in each business unit gives a fair representation of the size of the business unit within Morada. Why have they given that? Proportion of book value of non-current assets invested in each unit give a fair representation. Okay, so what's the proportion? Let's just say how much we are selling off. Then also we can reduce, see it from there, 30%, right? Book value of non-current assets will reduce by 30%. So that's the share of this what was that, repair thing, right? So 30% belongs to repair, right? So Morada equity beta is given. So why have we been given this? To help us calculate basically the asset beta, right? Asset beta and all, just to calculate CAPM as well, right? And then estimated is at this much currently, right? While the asset beta of the repair and business is estimated to be this much. Okay. Relevant equity beta for the larger new, including the construction unit relevant to the second director's proposal, is estimated to be 1.21. Okay, that's for the second director's proposal, right? Okay, after implementation, right? What about this thing? What is this line about? So this is about bond, it seems like. So it's about the bond. So bond is redeemable in 4 years at face value. Okay, that's important, face value. Because when we find the value of it, we need to discount it, right? So for the purpose of estimating the cost of capital, it has been assumed that debt beta is 0. Okay. However, the 4-year credit spread over the risk-free rate of return is 60 basis points for A2 bond, this much for this much for this, for C3 bond, right? So the bond information is there. We do have the tax rate, and then we do have the risk-free rate and market risk premium, right? So 7% is there. Okay, let's do this. Right. Okay, so answering tips, let's go from there. Okay, so answering tips, right? What do the examiners have to say? A lot of marks for calculating companies' cost of equity and capital in different scenarios. That's correct. However, note that there are also marks available easier question mark discussion points such as part A and C, right? The discussion session is there, and then 2 parts can be answered independently of the tricky cost of capital calculations, because we are discussing the impact, right? I mean A and C, you mean the question, right? So it's independent of them. So always try to answer this part first to build up confidence. Okay, so let's do that. Let's do first A and B. The owners or shareholders of the business will accept that it needs to engage in some risky activities in order to generate returns in excess. So the owners or shareholders of a business will accept that it needs to engage in some risky activities in order to generate returns in excess of risk-free rate of return, right? Because that's how normally we and that's the risk premium that we get, right? Plus the risk-free rate of return. So explain how these business risks and financial risks are related, right? So that's the first part. And then basically a business will be exposed to differing amounts of business and financial risks depending on the decision it makes. So differing amount, business risks depends on the decision a business makes with respect to its service and products it offers, and consists of variability in its profits, right? For example, it could be related to the demand of product, the rate of innovation, and actions of competitors, right? So these are core related to the business. So financial risks relates to the volatility of earnings due to financial structure of the business, and could be related to gearing, exchange rate risks. It is exposed to its credit risks and its liquidity risks, right? It's associated with its gearing, exchange rate risks, credit risks, and then the liquidity risks, right? All these are financial risks. A business is exposed to high level of business risks may not be able to take excessive financial risks, which is exposed to a high level of business risks, as the shareholders or owners may not want to bear risks beyond an acceptable level, right? So this is how they are related. So risk management involves, so second part is risk mitigation and risk diversification can form part of a risk management strategy. So risk management involves process of risk identification, assessing and then measuring the risks through a process of predicting, analyzing, quantifying and then making decisions on which risks to assume, which to avoid, which to retain, which to transfer, right? As stated above, a business will not aim to avoid all risks, as it will want to generate excess returns, not avoid all, right? It want to generate in excess of it, dependent on factors such as controllability, frequency and severity of the risks. Okay, so what do we have? Basically is not aim to avoid all risks, right? So it cannot avoid everything. So dependent on the factors such as controllability, frequency and severity of the risks, it may be basically able to eliminate or reduce, right? So we have the TARA framework, right? Risk mitigation is a process of transferring risks out of business through hedging or insurance, or through the certain risks, or avoiding, right? So using the TARA framework, right? Risk diversification, it's a process of risk reduction through spreading business activities into different products and services. What is risk diversification? It's a process of risk reduction through spreading business activities into different products and services, right? So this is also another strategy to minimize being excessively exposed by focusing exclusively on one product, right? So the way they are diversifying into the second director's proposal to diversify into this thing was basically, you can say, risk diversification, and it should be a part of a company's risk management strategy, right? Okay, so that part is done. Let's do question number C first of all, and then we can do this report section, right? So possible reasons for third director's proposal that a risk management strategy should consider each where is that, each risk before taking appropriate action, right? So this is an open-ended question, and a variety of relevant answer can be given by candidates depending on how the question requirement is interpreted. The following answer is just one possible approach, so credits will be given for alternative approach, right? So according to the third director, risk management involves more than just risk mitigation and diversification. Basically that's what it says over here, right? So she proposes it's just to reduce, should not undertake the proposal suggested by first and second director just to reduce the company risk profile. She feels that the proposal require a fundamental change in corporate strategy. She proposes a risk management system which should be set up to appraise current risk profile, considering its business risks and financial risks within the company, right? And take appropriate action wherever the risks is deemed necessary, right? So the risk management involves more than just risk mitigation and risk diversification as proposed by first and second director. The proposals suggested by the first and director are likely to increase the makeup of a company, change the makeup of a company, and cause uncertainty among the company owners and clientele. So in return, may cause unnecessary fluctuations in the share price. So she suggests that these changes are fundamental and more than just risk management tools. Instead, it seems that she is suggesting that Morada should follow the risk management process suggested in part A, right? Risk management process, where risks should be identified, assessed, and then mitigated according to company's risk appetite. The risk management process should be undertaken with a view to increase shareholders' wealth. Risk mitigation process. Therefore, the company should consider what drives this value and what the risks associated with these drivers of value, right? So it's basically we are always trying to increase the shareholders wealth, and then we need to basically, you just can't say we will not take any risks, right? So we have to take some risks. So and then those risks also should be considered or associated, like there will be some risks associated with those value drivers, right? So that's what they are telling over here. Morada company may assess some of the risks are controllable and some may not be controllable. It may assess some are more severe, other are not so severe. So it may assess some are likely to occur more frequently than others. So Morada may take the view that non-controllable, severe and frequent risks should be eliminated. On the other hand, where Morada is of opinion that it is a comparative advantage or superior knowledge, so they should accept it, or they should be able to manage them properly, right? So it may conclusion that it should accept this, right? So for example, it may take the view that it is able to manage events and flight delays or hotel standards, but would hedge against currency fluctuations and insure against natural disasters because due to their severity and non-controllability. So you see how they are giving us examples as well, right? Very important. So theory suggests that undertaking risk management may increase the value of company if the benefits occurring from the risk management activity are more than the cost involved in managing the risks, right? For example, smoothing the volatility of the profits may make it easier for Morada to plan and match long-term funding. Smoothing the volatility, right, may make it easier for Morada to plan and match long-term funding with future projects. It may make it easier for Morada to take advantage of the market imperfections by reducing the amount of taxation payable, or may reduce the cost involved with incidences of financial distress. In such case, the benefits occurred should be assessed against the cost involved. So for example, smoothing the volatility of profits may make it easier for Morada to plan and match long-term funding with future projects. It may make it easier for Morada, right, to take advantage of market imperfections by reducing the amount of taxation payable, right? So basically it can reduce basically the funding, basically the market, there is a lot of swings in the market, right? So that will basically reduce the amount of taxation which is payable, right? Basically because you can secure funding at a lower rate or higher rate as well, right? So that will basically reduce the taxation payable. That is one way of looking at it as well. And then it may reduce the cost involved with financial distress as well. So therefore, risk management process is more than just mitigating risks through reducing financial risks, as the first director is suggesting, or risk diversification. So instead of process, it is a process of risk analysis. Not only risk diversification and risk mitigation, it's a process of analysis. And then about judgment of which risks to hedge or mitigate, and finally which risk reduction mechanisms to employ, and depending on the type of risks, cost of analysis, risks and benefits occurring from the mitigation, right? Okay, that is also done. Let's come to this. Basically we have the report, right? So let's just come to the appendix first of all. Appendix. So in the first question, what we are supposed to do is we are supposed to find cost of equity and cost of capital under what? First director's proposal, second director's proposal. So this is for appendix 1, right? So cost of equity and cost of capital, right? Equity and cost of capital. So in order to find cost of equity and cost of capital, what do you need? You will need cost of KE, right? So before the implementation is done, right? So what do we have? Before the implementation is done, we do have a equity beta as well, right? So we can just simply use that, basically because in our CAPM model we can use equity beta, because we are not doing any adjusted we are not adjusting it for anything, right? So we can simply use that. basically. And then cost of equity will be what? It will be 3.8% plus CAPM model. We can use that. And then 7% is the risk premium. And then we get 12.2%. That's our cost of equity. For debt, it is what? Cost of debt right now is the risk-free rate plus what's our rating currently? I think it's B something, BA2, right? So 3.8 plus 0.9. 3.8 plus 0.97 something, 4.7. Yeah, that's what we get, right? And then what we need to find the cost of equity. We found, if we need to find the WACC, right? WACC, in order to find WACC, we need the market value and market value of debt as well. Market value of equity, what is it? Market value of equity, we know the share price, it's over here, times the quantity of shares, right? What is the quantity of shares? Let's look for shares. Okay, it's 50,000, but it's 40 cents per share, right? So 50 divided by 40, so that'll be what? 200,000. So that will be what? Is it 200? 40 divided by, okay, 50 divided by 0.4, right? 125. So 125 million, that's in million, times the share price. So that's the market value of it. Market value of debt, are we given market value of debt? Market, so these are book value, right? These are book value only. So currently we have a debt of how much? Bonds, right? 6.2. So we can value this. So we can just find the market value of debt by just discounting it, right? So basically 6.2 is the payable thing. So 6.2 every year we use the discount rate. What's the discount rate that we should be using? What's the rating right now? That will be our discount rate, right? So 4.7%. We found that already. So we use that to discount. So we use that as a discounting thing, and then it's a 4-year, right? It's a 4-year at face value. So it will be what? First year interest, second year interest, third year interest, fourth year we are interest plus the principal, right? And then we are just discounting it, and then we get 105.56 per $100, right? Per $100. And then how many quantity do we have? Our quantity is 120,000 divided by 100, right? Or you could just say 105.36 divided by 100 into 120 million, right? And then we will get the total market value is this much, right? And then cost of capital is basically, we know the formula, KE times the proportion of it, right? And then plus this thing. So basically KE times value of equity plus value of debt plus all this KD times 1 minus T times value of debt times value of equity plus value of debt, right? So basically we just get from there, we get 10%, right? And then okay, so that's done, right? For this market value, okay, so first director's implementation, right? What do we have? We have to reduce the debt. So before we had some debt which we will be paying off as well, right? So we need to find what? Let's just come to the heading again. We need to find cost of equity and cost of capital after the proposed changes has been made, right? So for that we already have a market value of equity is already there, right? Okay, we need to find the So since we are finding cost of equity, right, we need the gearing value as well, isn't it? We need that as well. So for that, we need the asset beta. You see, asset beta is basically, so in order to get the asset beta for, basically, you see, in this section what we are doing, we are selling off the repair and thing, right? So our asset beta right now, because you see, in order to get KE, we need like in the formula we need RF plus beta asset or equity, I mean beta equity, and then times your RICS premium, right? So RICS premium, right? So for that case, we need this beta, right? So in order to find that beta, what do we need? What's the beta that we have right now? So right now what we have is this beta for Morada company. We have this 0.65. That's the asset beta for repair and maintenance, right? So we are selling this, and the only thing we will be remaining is basically the other one. So this is a new beta for, that's for second proposal only. So from the 0.65, that's a asset beta, right? So asset beta of what? That's a asset beta for what? So that's a asset. You see what has happened over here is that basically the 1.2 is equity beta, right? So we have to ungear it. So this is equity beta. So equity beta ungear. So we know the formula is basically beta equity times the 360 million, the value of equity, and then we divide that with value of equity plus value of debt times 1 minus t, right? So we get the beta, ungeared beta 0.94, right? And then that 0.94 is for what? It's for whole company, right? So what does the whole company consist of? It consists of two parts. One is repair, the other is the other is travel services, right? Travel services. So how much proportion is this repair? It is basic repair is 30%. This thing is 70%, isn't it? Because 30% we are selling it off, isn't it? So current assets, the book value of non-current assets will reduce by 30% when we sell, right? Repair. So that means it has only 30%. So 70% is over here, right? So we can make a equation, right? 0.94 equals to repair beta plus let's just make it a bit bigger so that it's easier as well. I'll just remove this thing as well, yeah, just erasing everything and then just doing it again so that it's more easier. I don't mind if the video is getting too long or something. Explanation is important, right? Okay, we have the beta assets, right? Beta assets, right? So beta assets, this is for whole company, right, equals to 0.94. So what does this include? This includes repair plus the travel services, right? We've been given the repair thing 0.65. What's the travel services? We don't know, right? So beta of travel times, what's the proportion of this thing? 70% of the total business, right? So 70% of this is coming from this. So 65, we don't know. It's 30% of something is 65%. Okay, 0.65. So 0.94, right? So beta times 70% equals to this minus this. Okay, so this is also 30%. 30%. What am I even doing? 30% of that, right? So 0. This thing. Let's just make it easier. 0.65 times 0.3 plus beta times 0.7 equals to 0.94. So we can solve this equation by 0.94 minus 0.3 times 0.65 divided by 0.7, right? So that's how they are doing it. And then we get how much? 1.06. So this is the beta for travel business only. So that's pretty big, for rather than, you see, the asset beta of the whole company is 0.94, but for travel only it's greater. You see, it's just denoting more risks, right? You see, it's denoting more risks in that way as well, right? And then this is ungeared beta, right? We still have some debt. It's not a fully thing. We still have some debt. We have to gear it, right? For that, we have not done any calculation regarding debt at the moment, right? So let's do it. What's the 20% remaining debt that we have to find out, right? Remember, we are selling or paying off 80% of the debt. So what was our debt value before? What was our debt value? Debt. We are paying off that. So that means we do know the market value of equity. We do know that, right? Just need to find out the market value of debt. Market value of debt is basically we are paying off all those things. Where is that debt? 120,000, right? So 120,000 into 0.2, that's the remaining portion of it, 24 million, right? So that's the book value of it. And then we need to make that into the market value, right? So that's just the book value. So after that, what we need to do, we need to see the cost of debt. What's the cost of debt right now? Cost of debt will be basically, because our rating will improve, right? From BAA to A2. So A2 rating is how much? 60 basis points. So 3.8 plus 3.8 plus 0.6, so 6 2 4 14, so 4.4. That's our new discounting factor, right? Cost of debt. And then we can find out the value of debt or total market value of the debt by, basically we find out the market value per $100, right? So right now its market value is 106.47 per quantity, right? Per $100. And then that is basically, we simply use the same payout cash outflow, and then we just discount it at a different rate. So right now it's how much? It's 1.06, right? 1.06. And then the total market value, what has happened to it? So the market value will be basically the book value times, or the book value is the total. What is the book value, right? The book value consists of what? Quantity times the price, right? So we just divide the total book value by price, right? We get the quantity. That's what we need basically, right? Yeah, and then that's how we get our total market debt, right? And then we can simply use that value in our for gearing the company, gearing the travel services, right? Because we only have this much debt remaining. So we do that, we get 1.12, right? And then after that, we compute the cost of equity, because since we have the geared equity beta for the travel services only, so we get a cost of equity of this much, right? Cost of equity, so that's decreased, and then cost of capital can be computed since we have the KE and then KD, and then we do have like a market value and a market value of equity as well. So market value of equity just remains the same, right? Basically, because why does it remain same is of this assumption over here. You see, assume share price will not change because of that. So our cost of capital is 11.1. Okay, quite a lot of things to remember, right? But still can be doable. Just don't forget like calculation of this market value of debt. This is very confusing. Even anyone can miss it, right? So basically you compute the book value, and then after that what do? You once the credit rating has increased, you discount it at a different rate, and then you use that discount the cost of debt to discount it. You find the per value, and then after that what do? You compute the total market value of the debt. All right. And then after that we just use the asset beta and all to compute the cost of equity and cost of capital, right? So this is the most important part of it. Just this thing is adding more complexity to it, right? Just the debt part. Otherwise it's pretty simple. You see, like if you had been given like if the market debt has not been changed, it would have been relatively very easy just to compute that, right? So you see the debt part is that's where they are playing us. Right, okay, so under the same heading, under the same appendix, we have the second director's proposal as well. What is its proposal? Risk diversification, and then best way to reduce risks and therefore reduce its cost of capital. He proposes that the company raise additional funds using debt finance and then create a new strategic business. It will focus on construction of new commercial projects. So this 70 million should be borrowed and used to invest in purchasing non-current assets for the construction business unit. The new debt will be issued in form of 4-year redeemable bonds paying an annual coupon of this much. It is estimated that if this value of debt is raised, then Morada company's credit rating will worsen from CA3 to, from BAA to CA3. So in this case, we will be discounting at a higher rate. Right, if it is 4.4 over here, we will be discounting at a higher rate in the second proposal, right? That's one thing we know. Okay, we need to find the cost of equity and cost of cost of equity and cost of capital, right? Okay, let's find out the cost of equity and cost of debt first of all. So cost of equity is 360, right? That's constant. The basis points for 2.40 basis points higher than the free interest rate, giving a cost of debt is basically 6.2. 3.8 plus 2.4. 3.8 plus 2.4, right? 2, and then after that 2, 5, 6, 6.2. Yeah. And giving a cost of debt of 6.2, and then therefore market value. Okay, right now as well we are paying the same coupon, right? So you see what's going to happen over here is basically times 1 divided by 0.62 plus 2 times right, it's going to be something like this, and then the value that you will get will be 100 something. So So it will amount to 19 million, I guess. It will be basically same thing, like even though if you discount it, it's going to be same thing, because the additional debt that you will be getting, you will be borrowing at the same rate, right? At 6.2, because your credit rating has decreased, and then currently your I mean, this is the forecast, right? So if you will be paying this rate, right, 6.2% of it, right? So basically, what's the additional debt that we are taking? 70 million, right? From the existing, how much? 120,000. Okay, so this is in thousand, so 120 million, you can say. So 120 plus that rate, 120 plus 70 will give us 90, right? For this you will be paying the 6.2, and then for this also you are paying 6.2, so it's basically same thing, right? So our market value of debt will be that much. Or what we could do is basically what have we been discounting it at? 4.7, right? Could try it. Oh, where is that? 6.2 divided by 1.062, 5.84, 5.84 plus 1 divided by 1.062, right? Times 6.2. So 5.5 plus 1 divided by 1.062. I know it's not a good practice, but what can I do? 6.2. I just don't have the other calculator with me at the moment. So in the fourth year it will be $100 as well, right? So 106. 1 divided by 1.062, so that's first year, second year, third year, fourth year, times 106.2, so 83, right? So it has to be equal. So 5.84 plus 5.5 plus 5.28 plus 83.5, right? So it'll be exactly 100, right? Exactly 100, right? So this is per 100, so you're getting 1, right? Essentially. So that's what I mean, So you see, you're getting a value of per 100, right? Per 100. So that's the market price right now, right? So if you multiply your debt, so it's going to be 190 million, right? Into, let's say, into 100 divided by 100, you're just going to get the same amount, right? Like we did over here. Like we did over here. You see, this is going to be that, right? So you're discounting at the same rate, at whatever your coupon rate is. Basically, in that case, you will be getting 100 value, right? Right, and then after that, what are we doing? We need to find the equity beta of it, right? Basically, we've been given that 1.21. So you see over here, it's given, right? Relevant equity beta for the larger company, because it will be a larger company because we will have the construction company added to it. So that is reflected by the thing as well. Remember, our equity beta was earlier, it was 1.2. Now it's increased to 1.21, right? So that's a reflection of that as well. The numbers speak. Okay, so that thing is thing, and then equity beta is computed, and then we just calculate the cost of capital using our new debt. That's the important thing over here to remember. That's pretty much it. right? Because in this new proposal, whenever you're doing that, it's always easy to forget, like, right? So all these small details, right? So in this case, the new debt should be included, right? So always think about that, huh? These are the angles that we want to don't want to miss out on, all these small minute details. It's not a thing, you can't really think about all these things in an exam environment, right? It's very hard in a time pressure thing. So that part is done basically. You're right. And then we come to appendix 2. What do we need over here? Estimate the after tax earning. There was two parts to it. After tax earning based on first proposal and second proposal, right? And then we need to find the financial position as well, right? So okay, so we can forecast the after tax earnings. So it's current and then forecasted and then forecasted for second director, right? What's the after tax earnings? 28 million, huh? After tax earnings. And then what we need to take account is this thing as well. So it's estimated that the company will make a 9% return on any new investment. So in the second director's thing, right? In the first directors, we will be making a reduction. And these are after tax. So we will be basically have to add, okay, this is a 9% after tax earnings. Okay. Okay. So what was the amount that we were supposed to have? So in that case, we need to look at our assets as well, right? So there will be, so this is for existing assets. These are return for any new investment, right? So 9% decrease. So what was our asset that we were selling? 30%, isn't it? Current assets, 30%. So 30% into 9%, huh? So this amount into 30%, right, into 9%, right? Isn't that it? Let's just see, yeah. Let me just calculate that as well. 280,000 times 0.3 is 84,000 times 9%, so 7650. Similarly, for the other thing, a 9% decrease, that's what we calculated. What about the any new investment? How much are we investing? 70 million, is it? 70 million, right? So 70 million, 70,000 times 9%, 6,300, right? Okay, so let's look at it. Okay, there is interest saved. Okay, we have to compute for that as well. Yes, don't forget, I've forgotten about it, like right now. Okay, so there is reduction and addition over here. So the amount that we computed are pretty much accurate, right? Very easy to forget, like very easy to miss all this thing in exam environment. So yeah, don't worry. So interest saved, right? So so basically there will be two situations. In one, you will be paying more. In another, you will not be paying more. In this case, what will happen in the first director's case, you will be paying less interest, right? So as that, what happens, your tax shield will go away, right? Your tax shield will go away. And then in second directors, you will be having some tax shield as well, but you will be paying higher interest, right? So we can take a net amount of that, because see, you are taking after tax, right? So we are, what are we trying to achieve? We are trying to forecast the after tax earnings, right? So we will need to take account of that as well. So currently we are paying all this interest cost, right? In the future we won't be paying, so we will need to add that back, right? In the first four directors scenario, this 28,000 has what, it has the borrowing reduced from it, right? Because it's after tax, right? So it's already paid that, so we need to add it back, because we won't be paying that because we'll be paying off the debt already, right? So we'll be saving some money over there in terms of borrowing, so we will add it back to the after tax earnings, right? So how much are we going to add it back? How much are we basically how much was the loan amount, where is that? 120,000, right? So 80% of that, 120,000. So not 120,000 itself, but 120,000 into 0.8, so 96,000, right? So it's 96 million. So on 96,000 we are basically paying how much? 6.2%. And then for that, how much are we getting? The net benefit is 0.8, right? Because we need to subtract it for tax. So 47616, so basically rounding it off, 47612, right? So similarly in this case, we are borrowing additionally, we have to pay more, so 70 million and then 6.2 at this rate, so we'll be paying this much, right? Okay, another thing is profit on sale. Remember I said a markup of that much. How much was that? 28,000 into 30%, right? 280,000 into 0.3, so 84,000. So 84 million into 15%, right? So there was a markup somewhere. Where was it? I think it's in the first proposals. I think after tax profit of 15%, right? After tax profit. Okay, so that's for first directors, huh? Just try and segregate this. You see, like even in planning as well, all this thing, right? You see all this table that they have created, right? You won't have the luxury to create, like, think all these things. You could plan in the first, like, let's say 10 minutes whenever you're reading it, but it can't be that detailed, right? You can't be planning that much. So what you could be doing is you could be just doing a table for first director, and then you could be doing some other things, so you'll be losing a lot of time. Okay, so yeah, don't worry about that, like just try your best, right? Even I normally I won't be able to do it as well that much, so even like just trying it should help. And then what we are trying to find out is, are we trying to find out the increase? We're trying to find the impact, right? So what we can do is we can just find the increase in earnings, right? Or you could just put it in the discussion as well and then later on, but it's easier to calculate that way. That's what they have done. We won't have the luxury in the time constraint, right? So that's just the increase from 28,000 over there and then 28,000 to this figure, right? Okay, we need to forecast the financial position as well. So for the first position, what happens? So we have the current figure just as it is, right? And then for the first director, we will be making some changes to it. So what has happened? So our non-current assets has reduced by 30, right? So this into 0.7. Oh, we don't know what happened to the current assets, but we are selling 10% of it away, isn't it? 10% of current liabilities. Okay, current liabilities, where is current liabilities? Reduced by 10% into 0.9, right? Into 0.9, because 10% we are selling it away. Non-current assets, what happens? In the first thing, we are paying it off, right? How much are we paying it off? 80% of it. So how much will be remaining? 20%. So 120,000 into 20% will be 120,000 into 20%, right? 240. So 2.4 million. So also, or 24,000. Okay. So into 0.2, let's just say that. Easy, right? Share capital will be same because we are not issuing or doing anything else, right? With that. And then anything else? So we have found our total liabilities, right? We add them up, we get our total liabilities. What about the total equity portion? We just leave it as it is. And then what do we do? Okay, we also need to, so total share capital is as it is, right? And then for total retained earning, what we do is we add the profit for this year. You see the predicted profit that we had predicted over here, the 37,000. We add it up. We add this together. So 137,000. No. I mean 137,000 plus that amount increase in after tax earning, right? Because you see this is current forecast, right? You see it's for why you might say, why am I adding 37,802, right? So we are not adding 37,000, we are only adding 9,800. Why is that? Why? The question is why, right? Basically this is forecast for upcoming year. Yeah, this is also forecast for upcoming year, right? So 137,000 is basically let's say 0 plus, it's already been added, it's already been added. So let's say 50,000 was our retained earning, and then we just forecasted it to be added by 137 minus 50, 87,000. So 87,000, right? Or what we can say is basically 137 minus 28, 109. Okay, 109, right? So our profit was 109, but this year it's going to be plus 28,000, so it's going to be 137,000. But if we implement the first director's proposal, what will happen? The profit will increase by how much? So you could do it this way as well, 109 plus 37.8, right? So 146.802, same thing, right? Or since you've already used the current forecast, right, all you need to do is just add in this amount only, this 98063. You don't need to add in the whole amount, right? Because you just want the increase. This is also a forecast for upcoming year, this is also a forecast for upcoming year. So it's going to be what? X plus 28,000, or it's going to be X plus 37,802. So since you are already taking the amount which includes this figure, right, X plus 128,000, 137,000 figure, so all you need to do is just increase it by only this much, the change amount only, not this amount. Always remember, just think about it carefully. You just want it to be 146, right? That's why we are doing that. Okay, that part is done. So since we've calculated total equity and this thing, so we just what do we do basically is we subtract from this minus this, total equity minus that, right? So and then after that, what do you do? I mean, we just add it up, and then after that, what do? We basically have the total assets. So just put that figure in, and then we subtract from the total figure, we subtract the current and non-current assets, and then we get our current assets, which is a balancing figure. Normally in such circumstances, we normally have a balancing figure, right? And then after that, coming to the second director's proposal, right? So second director, what does he had to suggest? He was suggesting to increase the debt and everything, right? So non-current assets, we increase it, but by how much? 280, we are investing 70 million. Remember the debt amount? Isn't that it? It should be borrowed 70, right? So 128 plus 70, 8 plus 7, 15, so 350, right? So 350,000 is there. Same thing for the current assets, it's a balancing figure. And then what we need to do, share capital is going to be same thing, but what we are going to change, we are going to change the retained earning. Retained earning will change by how much? 28,000 plus 2800, so 137,000 plus 2828, right? The same thing over here, don't get confused on this. So it's a forecasted profit, right? That's why we don't add in the, if this was current year profit, what would happen? We would have added the whole thing, right? Would have added the whole thing. But since it's this amount already includes a forecast, it already includes a future profit inside it, so we just add the differential amount only. Okay, so this amount already includes 28,000, so what we do, we just add in 2828, right? So it's always good to dissect like what's inside the number as well, it's a good skill. And then non-current liabilities, right? So non-current liabilities, what we have, 120,000, right? And then what has happened to it, we will be increasing it, so 190,000 to 70,000 increase, so 190,000. And then for current assets, they are saying it's going to increase to 28 million, right? So we just increase it, add this two up, we get 407, put that value over here, subtract it from this, we get some balancing figure over here, right? So it just says retained earning is adjusted to reflect revised tax after tax earnings, right? Yeah, that's pretty much it. Now let's take all this information to our thing. What thing? To our report. Right, as I've told you, the report includes how many sections? So the first we'll be discussing about all this current equity and all as well, right? So that is there before taking into first director proposal, and then all this thing, and then we will have like after earnings thing. You can make it in different heading as well, and then we have some assumptions that we need to give out, and then we have some recommendation as well, right? So discussion, assumptions, and recommendation, right? In the discussion session, what we can do is that the table below shows the revised figure of the cost of equity and cost of capital, and then the forecast after tax earnings for the coming year. So we can just reference the appendix that we've created, right? For comparison purposes, figures before any changes are given as follows. So what has happened? Let's see. So under the first director's proposal, then there is the second director's proposal, and then there is like what could be done kind of thing, right? Just discussion on it kind of thing. So I guess that's what it will be, I guess, basically. Yeah. So the first director's proposal, although the cost of equity falls, you see, cost of equity, it has decreased, right, due to the lower financial risks. Why had it reduced? Due to lower financial risks. I'll show it to you as well. Okay, let me just erase some of this component over here so that it's easier for us to look at, and then it's easier for you also. Just give me a second. Okay. Let's just clear out all this thing. So we are looking at what? We are looking at the cost of equity, right? Or what is it? Cost of capital? Cost of equity, okay. Cost of equity, what has happened? 12.2. What has happened over here? In the second case, cost of equity, it has gone down. Why has it gone down? Because of our lower beta, right? Why has our beta reduced? Because of the debt, reduction in debt, right? That's why they talk about due to lower financial risks, right? Because of less debt. And the cost of capital actually increases. Why does that happen? Because you've got a lower proportion. Of course, it's going to increase of a reason as well, because you see the proportion out of the thing is also reduced, right? So it was 120. No, that's not a correct explanation for it. No, where is it? You see over here, the proportion has also decreased, isn't it? $25.6 divided by 385.6, 66 into 100, right? So 6%, right? So 6.6. What about that? 126.4 divided by 486.4. Okay, so that's the proportion has decreased as well, right? The debt proportion has decreased. So basically we will have a higher proportion of equity, which has a higher cost of 11.6. So that's why it's increased, right? And because there will be some kind of tax benefit that was supposed to be there, right? Because you see, it's not only 4.9 or whatever the rate is. It's not only that you are paying, right? So it's not 4.4 you're paying. It's 4.4 minus 1. Minus 0, or like let's just say into 0.8, right? So you're paying much lower on your debt, whereas on cost of equity, For equity holders, you're paying 11.6. That's a very high number, right? So that's what it's causing that. So what does it say? This is because even though the cost of debt has decreased, because our credit rating increased, right? The benefit of the tax shield is slightly reduced significantly due to the lower amount of debt borrowing. So because of the lower borrowing, right? So because of the lower amount of debt borrowing, the proportion of it. So added to this, the higher business risks reflected by the asset beta. Higher business risks. Remember the asset beta I talked about, 0.94, and then it was what, 0.94, and then it was what, this thing, right? 1.06. You see, what is currently happening is that I'll tell you how we are getting this 0.94 as well, so that it's more easier for you to understand. 94, right, equals to, plus, we come back to it, 0.65 into 30% plus 70% times 1.06. That's how we are getting it. 1.06 into 0.7. So how much are we getting? 0.742 plus 0.65 into 0.3, right? 0.195. So when we add that up, 0.742, 0.937. You see, in aggregate only, after you've multiplied it with the proportion, because of this, your asset beta was lower. Otherwise, if it were for only travel services, it would be higher than the overall company's asset beta. Okay, so it's, you see, this asset beta was comprised of this what was this other thing that we sold, the repair business, right? The repair business had lower beta, which basically overall reduced the company's asset beta. Okay, so it was the main factor. Otherwise, if it were alone, we would just be having only this beta, right? And that means the company is more risky. So this is sort of like you see, it's like diversification, right? If we were into, like, if your asset beta is only 1.06, you would enter into a business which has a lower beta. That would in turn reduce your cost of equity. Okay, so basically, because you will be gearing on this amount, on this asset beta, right? And then you will be gearing at a lower rate, and then you will be basically having a less cost of capital. Okay, that's what I mean. But anyways, just have a look at it. It's very interesting. Okay, and if you don't understand, do comment down below. I'll definitely help you out. Right, what else? So the higher business risk is reflected by the asset beta, just operating in the travel business sector only. Otherwise, what would have happened if it were in a travel business along with the repair business? It would have a diversified offering, right? That was basically reducing their risks. Okay, the higher business risks and reduced tax shield more than override the cost of debt, resulting in a higher cost of capital. The higher business risks and reduced tax shield more than override the cost of debt. Very important conclusion, right? Very important conclusion. This higher beta, what did it do? Where had it had an impact? It impacted this one as well. As you can see over here, this increased our overall equity beta, right? 1.12. What was the company's asset beta? 1.2, right? Okay, anyways, so it increased this, right, equity beta of travel business, because you're multiplying, or you're just taking a proportion of it, you're adding more to it, multiplying it, right? So you're increasing it. That definitely increases that, your equity beta. So that in turn, what happened, it basically already increased our cost of equity. Again, that was added, there was an additional thing that did that. So there was a less proportion of debt, right? That in turn increased the cost of capital. You see how they have analyzed the numbers as well, right? Let's see at the second director's proposal after this. So under second director's proposal, what has happened? Cost of equity, it has increased. Cost of equity has increased, or let's just say it's unchanged, right? A margin, right? A little bit increase, but it's not much. What about cost of capital? Cost of capital has decreased a bit. However, there has been a significant increase in cost of debt. Right now it is what, 4.7, right? It has increased to how much? 6.2, right? It has increased. It has increased the cost of debt. And then the cost of, however, the cost of capital has not reduced significantly because the benefit of the tax shield is almost eroded by the increase in cost of debt. The proportion must be higher for sure. 190 divided by 550, right? 34%. Yeah, the proportion is higher. Even our cost of equity is also higher, right? Cost of equity is also higher because we have a higher equity beta, right? So it's basically being whatever the tax shield there was, it's being eroded by the increase in cost of debt, right? Otherwise, normally what we would assume, like if you take on more debt, what would happen? You would have more buffer for paying less tax, and then, but what would happen is that basically the cost of debt would increase, right? This happened because their credit rating changed, right? The 4.7 to 6.2 move was basically from the credit rating, right? So that's how it basically affects as well, you know. Very important analysis, very important. So if no changes are made, then the forecast earnings, right? Forecast earnings. Let's just see this as well. So if no changes are made, then the forecast earnings after tax as a percentage of non-current assets will change by that much. Forecast earnings after tax. Okay, in that case it's 28,000, right? Where is that? 28,000, right? And then we divide that with the total assets, right? 280,000, or let's just say 280. So that's a 10% change, right? After tax, if no changes are made. Under the first directives, this figure would increase to how much? To double, because there will be some reduction in it, right? So I think there will be a reduction of how much? 280 times 30%, right? So 0.7. 196 is remaining, and then the earnings that we get is 37.8, right? So there will be an increase in earnings of this much. And even if the one-off profit from the sale of the non-current assets is excluded, the figure is still higher at this much figure, because we are excluding this figure 37.8 minus 25.2. I think it's 12.4, 12.6. Okay, even though we exclude this sale figure for the non-current assets, or just the business, the other business, what was it about? Repair, right? Repair business, right? Even though if we sell that, even without the sale, the return will be higher, right? Under the second director's proposal, the figure falls to 8.8, because we are only getting a return of how much? 30.8 out of 350. Because why has this become 350? That's the question, right? Because we are adding 280 plus the 70 debt. That's why it's 350. Okay. We are taking the proportion of it. Proportion of non-current assets. Huh? It's important, like it's can't be thinkable in a short period of time, but yeah, very important analysis. This I like this one even better, how they have explained, like how the tax shield was eroded and all everything, right? How tax shield was there. You would assume, like if you had more debt, you would basically have the higher benefit of tax shield, but right, but what happened, the credit rating, they degraded, right? And that basically increased the cost of debt, and which basically eroded the tax shield what was there, right? All these things, the explanation that they give is very important, right? Similarly in this case as well, it's very important how they have compared, like how the higher business risks and then the reduced tax shield as a proportion of the debt, right? Because of that, how it has impacted, that's very important. And how the asset beta of it, right? Assumptions. So we can basically get all these assumptions from the question, but yeah, there were some assumptions made. So assume that the asset beta of Morada company is a weighted average of asset beta of the travel services and the managed services business unit using non-current assets invested in each business unit. Remember, we did that basically based on the investment in each business unit, right? And they are a fair representation. We can just write that assumption that was given as well in the question. Again, this thing, what is this share price assumption? Share price not changing after either proposal is not reasonable, so we can definitely write it. If you don't think anything is reasonable in a real world, just write it down, does not matter, right? It is likely that due to the change in business and the financial risks from implementing either proposal, the risk profile of the company will change. The change in the risk profile will influence the cost of equity. What will happen to the cost of equity? Of course it will change, which in turn will influence the share price, right? You would basically be discounting it at a higher rate, right? Which would basically reduce it. So in determining the financial position of Morada, it is assumed that the current assets will change due to the change in profit after tax. So that is the balancing figure, right? That will change. Yeah. So I mean, in this case as well, whenever they are changing, like if you change the risk profile of a company, that will have a lot of impact, right? It will have a lot of impact. So you could write a bit about this thing in the conclusion recommendation as well, I guess. How, like the second director's proposal could or the first director proposal, both of them could have a impact on the shareholder. It is recommended that neither, okay, so we are giving a decision recommendation as well, neither of the proposal should be adopted, and then the second director's proposal results in a lower return on investment and virtually unchanged cost of capital. So there will not be a meaningful benefit for Morada, right? Basically, we are just, you're not going up, you're not going down, right? You're just constant. So that's not a reliable thing. The first director proposal does increase a return, but results in higher cost of capital, right? So if the reason, so even though the return on investment is higher, but you're basically paying it out, right? So basically your cost of capital is higher. So if the reason for adopting both the proposal is to reduce risks, this is not achieved, right? The risk is not being reduced. The main caveat here is that where the assumptions made in the calculations are not reasonable, they will reduce the usefulness of the analysis, because we've made some pretty useless assumptions, right? Let's just say that way. Share price will not change. What is that, man? Like, come on, if you're going into a new business sector and all, and then like you're changing the whole corporate strategy, and then like the share price won't reflect that, that's not going to happen, right? Yeah, another thing is like the asset beta that we are using, it could be like the market, we could talk about that as well, but yeah, like the market beta that you take as well, the prices of the market, right? So they may not be a it could be in a swing or something like that, and then it's not a let's just say it's not showing the true picture of it, true picture of a company's valuation, right? So that could be there. Many factors to consider, and then of course we have to write report compiled by, report date. Let's just see the marking scheme as well. Relationship between them is 3 marks. Alright, remember the first part where they basically explain what business risks is, financial risks is, and how they are related. Risk mitigation, how can they form as a part of thing, how it is. Risks management strategy is not only about risks diversification and risk mitigation only, right? So it's a lot of analysis, it's a process kind of thing, right? That's how they described it. So in appendix 1, cost of equity 1 marks before the implementation of the proposal. These are market value of debt was given a higher marks because of, remember, we had to discount and everything to find that, right? Pretty sure in this thing as well, discounted debt is basically been given higher marks in the first proposal. In the second proposal as well, the debt computation, remember, that's where the trick is over here. Otherwise it would have been very easy. This appendix 1 would have been very easy if it were not for the debt. It would have been very easy. Adjusted earnings, first director's proposal. So these are a bit a thing, but yeah, it takes a bit of time, right? So it's a bit of a thinking process, and it's 2 marks. I think this should have been 3 marks, I guess, but yeah. For why am I saying 3 marks is basically it could be divided into 3: the profit from the sale, and then the interest saved, and then the additional earnings. But yeah, okay, so this is second 2 marks, right? Adjusted earnings from second director's proposal. Okay, second director's proposal is that financial position is 1 marks. Okay, that was relatively easy in terms of second directors because it was less computation kind of thing. Understandable. And what about the discussions thing? So you see, for assumptions only, we are getting 2 to 3 marks. Ooh, this is very easy to score, I might say, because you see it's given in the questions as well. We get some hints about assumptions over there as well, and some recommendation part is always there. So even though your numbers are mistake, always give out the recommendation, because the recommendation is based on this number, right? So it does not matter even though if it's wrong a little bit, right? But the recommendation will be slightly different, but still you'll be getting some marks. Discussion, of course, always do the discussion. So it's always important just to see the marking thing as well, like what the question is trying to ask us. C number is 1 to 2 marks per point. So give out all those things. Check the marks. Based on that, target the marks, answer for it, right? It's not only about just doing the exam, just the numerical only, right? So it's about making a bit of analysis, doing a bit of reasoning as well, right? So like they did over here. So yeah, very, very interesting question. I had a lot of fun. So yeah, if you have any questions, do let me know. Until next time, take care and like, share and subscribe. Bye bye.